Hello, and in case you missed it, a major event happened yesterday. Yes, the Feds cut the interest rates by a momentous 0.5%. I think the markets reacted very favorably today, but that's nothing compared to what I believe this is going to bring, and why we are so excited about what the future presents. This could be the beginning of an unprecedented boom cycle. My name is Sunil Grover. I'm the managing partner of True Blue Partners. We're a merchant bank running a early stage venture capital fund focused on AI in the enterprise. Uh, Over time, we've delivered numerous returns in both advisory capacity and in an investing capacity. Some of the examples are enumerated here. We focus our investing and advisory work only in enterprise SaaS, and within that, within AI and ML, having a meaningful impact to the business applications there. And to these companies, we bring a relationship network and a corporate finance expertise, and we often are the first institutional check in companies that are on the path to get to $100 million ARR. Some of the companies in our portfolio at different stages of their evolution in different segments of the enterprise market are listed below. They range from AI and customer support, call center operations, revenue operations, onboarding, digital freight brokerage, vertical solutions, and then Gen AI detectors of AI and creators of video AI. We also have infrastructure investments, although that's not our core focus, in data security and data processing. So in this 10-minute talk, I'm going to talk about what happened. Feds reduced the interest rates by 50 basis points from 5.25 to 5.5 to 4.75 to 5. So 50 basis points reduction. This could be the beginning of a new era that will be bigger than what we saw from 1994, when Mosaic and Netscape just came out, all the way to 2000. How long, how big, how fast, I don't know, but it's going to be big. Potential to see that AI driven unprecedented boom in productivity. And it's going to happen a lot faster than the productivity boom that happened because of the use of internet in various enterprise applications. These macroeconomic shifts will favorably impact uh, the opportunities for investing both in the public markets. It's going to impact the GDP, and it's also going to impact startups and venture capital investments quite favorably. Why do I feel that way? Well, let's dig into some numbers. Uh, I'll, this chart, for some of you might have seen this before. On one y-axis is the valuation multiple to total revenues. This is a proprietary SaaS index. This one is the NASDAQ, and this blue line here represents the Fed's fund rate. I divide this chart in 3 or 4 eras. Up to March 2020 was the pre-COVID era. Valuation multiples for SaaS were that 8x weighted average basis. NASDAQ was in 3.5, 4x weighted average revenue multiple. And then the COVID stimuluses. First, of course, there was a lot of panic and shutdown, but then the market, the Fed and the government realized they'll have to do something, and they did a lot. They did fiscal stimulus, they did monetary stimulus, and that led to a huge valuation inflation. Unfortunately, that also led to asset prices increasing, the wealth effect, and that led to a downstream heating up of the economy and inflation. Too much money flow leads to inflation. There's no two ways around that. And I think that valuation peak happened at the end of December 21. Many of the phenomenal exits that you saw on the previous slide happened in that time period. You work a lifetime in the startup uh, journey, and one day you become a multimillionaire. And that was the time where we cashed in the chips and harvested many of the investments that we had made, and the cultivation that we had done for many years and decades prior to. Uh, the same cycle is going to happen again. Now, what happened in the next phase from January 22 to November 23 is that the interest rate started increasing, and like gravity, interest rate increases the cost of capital, it reduces the valuations that companies get, and it takes money flow out of the economy. And the reason why this was needed was to reduce the inflation pressure. And I'll talk about inflation in another chart. And then was a period of fixed interest rates that lasted for almost a year. And yesterday, on Wednesday, a new era began, which is reducing interest rates. And that is something we have not seen in a long time. We started seeing a little bit of that here, and look what happened. I think that has the potential and possibility to happen again. However, the other factor that's working here this time around is AI. AI boosting productivity and therefore keeping inflation in check. That's a real possibility. There was nothing that was boosting productivity. In fact, productivity declined in a meaningful way because supply chains were affected. People were not going to malls, restaurants, and movie theaters. So productivity was declining and money was being thrown. Inflation took off. This time it's very, very different. Uh, Headline CPI. So this is what affects the wallet. It's a basket of goods, and how much is that price changing. This y-axis talks about the inflation rate, and this one captures the NASDAQ index. So as you can see, now correlating back, May 21 is kind of in the middle of the COVID era. Inflation has started to take high. Is it, if anyone remembers, this is transitory? Well, it wasn't transitory. Inflation ended up going as high as 9.1%. And if you go back here in June timeframe, it became very clear that the interest rates were going to start slowing down that inflation rise. That happened. Uh, and we've had now what many would call as a very soft and smooth landing. When it became clear that the inflation was coming under control, the trends on NASDAQ started to reverse. Now, keep in mind the growth rate of, let's just call it the weighted average. What this talks about is only valuation multiples, not a full NASDAQ index like this one. This is a full NASDAQ index. So revenues increase, valuations increase, you have a multiplier effect on your stock prices and the wealth in your stock brokerage account. Uh, so here, as you can see, in August 24, inflation is quite well in check. The target that Fed wants to hit is 2%. It was at 2.5. Now, this is headline inflation, so it includes a lot of volatile items like food and energy. If you take food and energy out, the commodities were actually having a deflationary pressure. That usually signals recession. But I'll show you data in some of the slides that follow that there is no recessionary pressure that at least I can see. Gasoline prices declining that much can cause a lot of fear of recession. Shelter is also notable in the breakdown of the CPI because that remained high. But remember, shelter comes through rents and rent equivalent of home ownership. And those, just think of a rent. You take a rent, it's a 1 year lease. So the impact is a little bit delayed. So a 5.1, 5.2 does not make anyone nervous. But when you start seeing deflationary pressures and things that are early indicators of economy like commodities and gasoline, the fear that starts building in is maybe recession is setting in, uh, and some of that may have been true, or may still be true. Uh, but I'll show you data that shows that's not the case, and then I'll explain why. This chart looks at the month over month change in inflation. So a 1.2% change in inflation in a month times 12 is 14.4 on an annualized basis. Now, of course, it doesn't stay that way. It goes up and down a little bit. But that, as you can imagine, June 22, that was a very scary month. Oh, well, it turns out it was just a little bit volatility because this is headline, CPI. Uh, in about October timeframe, people started anticipating that maybe the Fed's fund rates are going to start coming down because we had a pretty stable, although a little volatile time period. But then this four dot plots in four data points, a trend does make, and this seemed a concerning trend, and Fed announced that they were not planning to lower interest until much later in 24. Earlier, there was anticipation that interest rates might start getting lowered in early 24, and then that cooled down things. And then things now at 0.2%, multiply that by 12, that's 2.5. It's headline numbers, but 2.5 is a pretty good inflation number. Utilities, again, negative, so deflationary pressures, um, and some of the other things that we've already talked about. Month over month, multiply that by 12, gives you an annualized number, which is different than the last 12 months number. Now, this is the number that the Fed really cares about, the core PCE, the personal consumption expenditure. Uh, Microeconomics 1-on-1, price of a good goes up, consumer feels the pain, goes for cheaper substitutes. Um, Eventually, what matters is how much is the consumer spending, because that's an indication of how much money is flowing in the economy. Consumer contributing to almost 70% of the GDP impact. And so the number that the Fed looks at is the personal consumption expenditure index, and how much is that changing. So as you can see here, um, it went up from 1.72 is the target again. That's a pretty happy number. You had COVID happen, followed by, this is post-COVID. It went up a little bit, and I think it became very clear, if you remember, that this was not going to be transitory. And so the interest rates went up. You've seen the other slides, and now you can see this. This is as smooth and soft as of a landing as anyone could have orchestrated. 2.8% for 3 months in a row, 2.6% for 3 months in a row, or maybe it's going to be 2.54 and 2.2. The fear was maybe what if it falls off? And now you have a recession. So time will tell, but things are looking pretty okay now. There's always the possibility that the market gets overexcited and these numbers start shooting up. We sure hope that's not the case. So uh, these revisions now, what we look at very carefully, even when we are working with our entrepreneur partners, we request them to put together a plan, knowing fully that early stage in a company, making a plan, the actuals may never meet a plan, but the question is not so much did the actuals meet the plan, but if they were different, why they were different. Therefore, do we understand the business a little bit better? What did we think? What did we find? What's the delta? Can we improve our understanding of the business? And you keep doing that month over month, quarter over quarter, year over year, and you start understanding your markets and your business models very, very well. And that's a good foundation to get to that 100 million ARR of an impact. Now, same for macroeconomic. Um, there are forecasts, and forecasts are never met. But the question is, why were they not met? What can you learn from it? And we look at that fairly closely. because what happens in the economy impacts public markets, impacts individual investors' wealth, impacts flow into venture capital investments, and also impacts the revenues that these companies make. So we look at that, very holistically from a macro perspective, and then of course very granularly from each customer, each product, each feature perspective. Now, this is an interesting chart which talks about the labor market conditions. There's a lot of this fear or layoffs are happening, and tech has had more layoffs than the non-tech spaces. But if unemployment is trending upwards in a concerning way, indications are recession will follow. Let's look at the data. Uh, one of the blue line here shows the employment to population ratio, total in number of people employed divided by total population. It's hovering in that 60% range. What does 60% really mean? Uh, the highest it's ever been is 64.7% in April of 2020. That's the point where the bubble in the dot-com bubble bursted. 64.7. Lowest it's ever been is 51.2% in April 2020, which is when, in my other chart I showed you, the COVID shutdowns happened, everyone was furloughed, and 51.2% employment to population ratio. At 60%, we are much closer to 64.7% than we are to 51%. And I'm not taking Great Depression and not that far, just the last 20-25 years. Uh, if we look at the unemployment, the numbers have edged up in the recent months, and that, of course, can start giving concern. Are we getting into that recessionary period? But at 4.2%, again, the range has been 10% in 2008, 2009, and the lowest it's ever been is 3.5%. So if you can see, obviously there's some oscillation that these numbers keep getting corrected, uh, that we're just coming off the lowest it's ever been in the last 25 years. So, yeah, something to watch about, but I wouldn't be too concerned about it. The quit rate has been declining. Remember the great resignation era that we had right after COVID. Uh, well, that's declining. That's healthy. That's a positive trend. Um, Total number of people employed in the U.S. U.S. employed people over time, 161.43 million people. And what does that mean? Uh, from a historic trend, the total number of US employed people, well, it's close to an all-time high that it's ever been. So what does that indicate? If you look at the fact that the highest um, uh, employment to population ratio is around 65%, we are at 60%, means in 8% or maybe up to 10% upside potential out there. Uh, there's still upside potential in how many people get employed, means how much money gets into the markets. The 10% upside is out there, which may or may not get realized, but could get realized in the next 2 to 3 years. And then there is the whole element of productivity, labor productivity. So this red line that talks about percentage change of labor productivity outcome, uh, and the red line talks about labor productivity output per hour for all workers in US. And then this one talks about month over month changes. So what you can see is that the trend is clearly very positive uh, from the pre-COVID era to the current era. Generally, productivity trends that way. And if you see this recent spike in productivity, that's coming from Q2 of 2022 onwards, which is when the supply chain started humming again. People started going to retail stores. What this is not included yet is the impact that AI is supposed to have and will have on the employee productivity in the enterprises. The numbers that we are looking at are 30 to 40% improvement in labor productivity of employees. Um, Couple that with the fact that there is another 10% upside in how many people can get employed, and there is a lot of room for the economy to grow in the coming months, quarters, and years. So, what do we expect in the coming years, next 12 months or so? I would say, inflation is cool. Fed's going to catch up, and interest rates are headed towards that 2 to 2.5%. We do have a period of the political environment that's coming up with the presidential elections, and no matter who wins, there will be a regime change. However, this regime change may not be as brutal as the regime changes that happened in 2000 and 2008, because both sides are kind of familiar organizations behind them. 2000 and 2008 was a major shift and led to a lot of chaos when that shift was happening. And then we hope that's not going to be the case. We have reason to believe that won't be the case this time around, no matter what your politics are. Um, and then there are always the global, threats, nuclear threats, or the China-Taiwan supply chain issue. Any of these bubbles up can have a negative impact, but you know, there's a lot of firepower that Fed had and has, and you saw what happened when COVID hit, and and this Fed chairman is not afraid to use the tools that he has available. He is a investment banker turned Fed chair, unlike the previous ones who were more academicians turned Fed chairs. So more a man of action. So net net, interest rates have gone down. We are getting into a new environment in the next few months and quarters of declining interest rates. AI is going to start having its impact in the enterprises that can boost productivity by 30 to 40%. There is still a lot of room for employment to increase and productivity in employment to increase. Uh, with interest rates going down and productivity going up, there is the possibility that we can have a lot of growth without a lot of inflation because productivity is increasing. It's not just a monetary phenomena coming up in the next 5 years. It also means it's going to be a positive wealth effect. If you're invested, if you're not invested, this could be a good time to look at the stock markets very closely and consider keeping certain portion of your portfolio in early stage venture capital, which does take a longer gestation period, but has the outsized effect of massive creating massive companies from the ground up. What's coming up next is, so what does that mean to SaaS valuations today, and where they can go in the next 12 months or so? We looked at that. We look at that on a regular basis, and I'll share that by vertical, by size of company, by gross margin, by growth rate, what drives these valuations in the public markets, because private markets are headed towards public market. They take the direction from there. Therefore, what are the parameters that are most important for entrepreneurs to, financial parameters that are most important for entrepreneurs to focus on, and how can their product characteristics, go-to-market characteristics, the sales cycles impact those favorably, therefore create a lot more wealth for themselves as entrepreneurs and for their investment partners. Thank you very much for listening to this presentation. The slide and the detailed recording should be available. If you would like to have the Excel files or other data that's behind it, just let me know, and we'll have someone send those over to you.